What happened in this month was one big announcement with the GST cuts. And from a macro perspective, I think it's a superb step in the right direction because it provides a lot of support to the economy, which is required at this point of time to ensure that the impact of tariff is minimal.
Do you see RBI going live for a rate cut in the upcoming monetary policy?
September might be a difficult ask for even RBI to look at a rate cut because they've already, as you rightly highlighted, it's a very, very strong number. GDP, I think our expectation was above 6.5, 6.8%, but a 7.8 is a significant stronger growth number.
Hello and welcome investors. You are tuned into Moneynomics by Axis Mutual Fund. I am Shalini Gautam and I have with me Head of Fixed Income, Devang Shah.
Hello.
Devang and me today will be discussing the developments in the bond markets. Last time we spoke about long duration bonds, and now from that point to tactical opportunities in the fixed income markets. So let's first take this up. How has the scenario changed for you?
Well, thank you, Shalini, and welcome everyone. So what we believe, I think, is that this month there were two big events, okay, and which actually led to significant volatility in our bond markets. Actually, from the time when we spoke last month, our long bond markets have actually sold off by another 20-25 basis, and the entire curve on the government bonds has seen some volatility and pain. The question arises why? I would say there are two specific reasons why we believe that created a lot of nervousness in our bond markets. We already alluded on one point last time, is that the demand supply dynamics is actually getting a bit of, there is an imbalance there where the supply of bonds is more and the demand is somewhere down the line not very incrementally growing at the same pace, and that led to the sell-off in bond market yields. What happened in this month was one big announcement with the GST cuts. And from a macro perspective, I think it's a superb step in the right direction because it provides a lot of support to the economy, which is required at this point of time to ensure that the impact of tariff is minimal. But what's nervous or making the bond markets nervous is the overall perspective that if GST cuts are there, first of all, there will be a limited impact on growth going ahead. And if there is no much impact on growth, will RBI look at future rate cuts? So that is one aspect. Secondly, what worried bond markets is that with this GST cuts, you can actually see some additional supply on bonds. Already demand supply dynamics, there was an imbalance which we spoke in the note last month. With this incremental GST cuts, there can be some additional borrowing and which can lead to some pressure on bond market yields. Large part of the sell-off happened because of the this fear which is now creeping in among I think capital markets and bond traders. Our perspective out here is this, that today if I look across at levels now, and the levels have sold off from, I would say, from its bottom. If I look at the June policy, the large part of the gains which happened on account of rate cuts have all got reversed. Bond market yields are actually trading at February 2025 levels. So a large part of the gains being reversed, we believe that this is an opportune time for investors to look at some opportunities in duration. Okay. The another important aspect is that the second announcement which I spoke about is that this additional tariff getting announced of 25%. With that additional 25% tariff, now the tariff rate on India will be 50%, which is one among the highest among all our emerging market partners and all, which can lead to some bit of impact on growth. If RBI believes that yes, the forward-looking growth projections look weaker, they can do a token rate cut. In this environment where bond market yields have sold off, this entire bit on RBI doing a token rate cut, possibly in October or December monetary policy, can lead to some tactical opportunities for bond markets. So that is why we came up with a communication that there are some opportunities in investors for at this point of time.
Absolutely. Now, I want to understand from you, our GDP numbers came out really strong. Given the way the GST rationalization is going to be and the tariff impact is going to be, you think that the GDP growth going forward will be low. Do you see RBI going live for a rate cut in the upcoming monetary policy?
So my view is that obviously September might be a difficult ask for even RBI to look at a rate cut because they have already, as you rightly highlighted, it's a very, very strong number. GDP, I think our expectation was above 6.5, 6.8%. But a 7.8 is a significant stronger growth number. Obviously, there are some deflator impact, there are some kind of base effects which are working in favor of the growth number, but the underlying trends and the underlying internals are quite strong. So as per me, I think September policy is a difficult time for RBI to look at.
October, you mean?
September end is the policy and October beginning. So September, October might be a difficult time for RBI to look at rate cuts. But we believe that what is now creeping in the mind of I think probably central bank as well as policymakers is that if the outlook continues to remain quite weak on the growth side, and the next second half of the year, and specifically as I told you, that that additional tariff can create a overall sentiment which is weaker. If that happens, then RBI might look at one token rate cut. And we believe the faster the RBI does it, the better for the economy. So our perspective is that with this additional 25%, if it continues, okay, RBI can look at one rate cut.
Okay.
If there is this 25% additional tariff reverses, and we see the reversal happening very soon, I think the GST rationalization and the GST cuts are good enough to support the economy, and then we believe so that we don't require any additional rate cuts. RBI might be on a long pause from here for the next 6 to 12 months.
What about the US? So the Fed chair has said that he may be looking at lowering interest rates in the upcoming monetary policy. Do you really think the interest rates be lowered, or it's just a symbolic rate cut that's going to happen?
So we believe that, see, first of all, the fear of inflation which markets had because of the tariff implementation and all that, you will see significantly higher inflation in US. It is not still creeping up. If you look at the US inflation number, is not so high. In fact, US inflation is somewhere between 2.5% to 3%. Our overall next 6-month projection also continues to be around 3%.
Okay.
What is important to note is that the trends on growth are significantly weakening. You actually started seeing unemployment data weak, you started seeing retail sales data weak. So that is what is urging Fed to look at some bit of rates easing at this point of time. We have continued with a stance that Fed will do a couple of rate cuts in this year, and we believe so that Fed will deliver 2 rate cuts in this year. Next year, our view is that probably you might start doing some uptick in inflation. That is why the probability of Fed to cut rates will be lower.
Okay.
We continue to hold a view that 2 rate cuts in this year and 2 rate cuts next year, taking the terminal rate to close to 3/4, 3/2 is where we believe so Fed will end its rate cycle in this cycle. The important point also is that why we are actually being tactically bullish at this point of time is that along with this RBI twist which can happen on account of lower GDP print or the forecast of print growth being lower, we also expect that the Fed rate cuts also might help bond markets for the near term. So you have a scenario where you will see some positivity coming from global bond markets. You might see a surprise from RBI, probably lower growth expectation. And if the H2 borrowing calendar is rejigged a bit, I think that opens up some sort of tactical opportunities in the near term.
Great. Now, against all this backdrop, where should investors really look at investing in the fixed income market?
So, Shalini, we have been reiterating the fact, and I'll continue to advise clients that we need to first understand that this is the fag end of the rate cut cycle. So, yes, we are a bit, because of the entire sell-off in bond market yields and the levels where they are, this offers some tactical opportunities for bond investors, but we are at the fag end of the rate cycle, and we continue to advise investors to stay in the short end of the curve. The 1 to 3 year segment is what we believe so makes a lot of sense. So obviously the overall perspective from a tax optimal solution perspective, income plus ARP stands out as a one good stop solution for clients going ahead, with some tactical opportunities in long duration fund at this point of time. So that's our advice: income plus advantage, short term bond funds. And the second thought process is some tactical opportunities in the gilt fund.
I think all of these views of yours have also been highlighted in our Acumen series and also in our Outlook pieces. Thank you so much, Devang, for your valuable insights. And thank you to all our investors for tuning in. Please stay tuned to Moneynomics by Axis Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.